Good morning, everyone. Happy Wednesday, and it's weekly profit talk time. We do this every single Wednesday at 8:30 a.m. if you are in the Mountain Time Zone, the Rocky Mountains of the United States of America, like I am here in Colorado. Our topic this week is: Can incorporating your medical practice reduce your tax? This is kind of a deep dive into a series of topics that we're doing. Basically, I've been interested in informing you, my medical practitioners, to the best of my ability, arm you for what may be coming in the uh, recent and near term future political landscape. Of course, these things always translate to changes in the tax code. There may or may not be changes, and I'm going to go into a little bit of that with you. So, first of all, they're making me do this in two steps. Give me one second here. And let's go ahead and begin. Um, with all likelihood, you are already some sort of limited liability company, perhaps even limited liability partnership if you have more than one clinician in your practice. Chances are, this is actually a true statistic. Over 90% of S corporations are actually sole owned, just one person. If you are already an S corporation, congratulations. That's basically saving you thousands of dollars a year if done properly. Now, what I mean by proper is that your federal government insists that you take a reasonable compensation from the money that you make. But as you can tell, S corps are tricky. If you've been in business for a few years, your first year or two, you might think, well, doctors should make somewhere, even new doctors should make close to six figures, 80 to $120,000. But what if your practice didn't make that much out of after all expenses? Well, that's always a possibility. And the answer to that is reasonable compensation. It can also be translated to mean that you cannot reasonably be expected to take more money out of a company than you have in it. So that is when working with a business advisor, such as myself, can be to your advantage. Help you to basically navigate those uncertain waters, as it were. But at the very least, you should be a limited liability company already. I'll touch on that real fast and then we'll move on because I want to talk about corporation. But if you are not, and you're basically filing your business income and expenses on Schedule C and attaching that to a 1040, you're paying a mountain of extra tax. That can be a subject for another time, but it's basically this simple. Self-employed sole proprietors pay self-employment tax on Schedule SE. Schedule SE attaches to Schedule C. Schedule C attaches to the 1040, and you pay double tax because you're paying all of the Medicare and Social Security for your business income, both the employer and the employee side, minus a very negligible adjustment on the employer side. So I know the effective tax rate of that's 14%. If you make $100,000, that means you're paying over $14,000 in this tax, and you still got to pay the income tax. Typically, taxes are going to be over 25% for sole proprietors. You really want to be a limited liability company, and you want to look into S corp if you're brand new in business. If you have questions about that, let me know. We're on three different social media here. Facebook as well as LinkedIn and YouTube, and every one of them has a message capability. So shoot me a message and we can talk about that. If there's something you have questions about, you can do that anytime. And we're watching everything every single day. Maybe not always Sunday, but I digress. So as your business grows and you find yourself making over a certain amount of money, and I'm going to tell you that if you are married, chances are you may be by the time you're looking at making over $480,000 to $500,000 as a married couple on the adjusted gross income line of your 1040. And that is basically all of your income added up together minus some adjustments. But before the standard deduction and your qualified business income deduction, AGI is what the lenders look at if you're buying a new home. So that's an important number. And if that number is getting up over $500,000, chances are that means you're approaching or are already in the 37% tax bracket. So that's what we want to talk about today. Moving on. Um, so, tax reform back in 2017, which was put into effect January of the following year, 2018, basically reduced the corporate tax to a flat 21%. It was 35% in 2017. So it is possible that if you choose to actually tax your private practice as a corporation and move away from the S corporation model, you could, in fact, save quite a bit of money by doing so. But there are considerations. You still you have to take a salary from it. And in fact, you're going to want to because that reduces your taxable income. Another consideration, C corporations are basically an entity unto themselves. You might remember that whole 1% Occupy movement sometimes back where the young people were saying that the corporations aren't people, but they are taxed as a separate entity. Okay, so you're basically going to have a business that is taxed and has a tax return of its own that does not flow through to your 1040 anymore, like your S corp does. So you're basically going to be paying taxes on that, and then whatever salary you're taking out of that, of course, you'll pay tax on as well. So you have to balance all those pieces because there's intricacies there. Obviously, first of all, you've got all the expenses of your practice itself, and you do want to try to the best of your ability, plan your taxes for your C corporation so that it's paying as little tax as possible. And you will have, in fact, tax plan for the money that you take out of the business. You are able to take distributions, but there's certain rules for that as well. So it's definitely worth investigating if you are getting to that point. And that could easily be, depending on your level of success and word of mouth and the growth of your practice, you might be in your first few years and already be thinking about this. And that's why I'm sharing it with you today. So let's go over a couple of considerations. First of all, the 21% tax rate, will it remain in place? I do want to share with you that it's called the TCJA, which is Tax Cuts and Jobs Act. We've discussed this in previous weeks. It sunsets on December 31st of 2025. But by then, we're going to have a brand new Congress and a brand new administration, and all be inaugurated in the next month. We're recording this on the 11th of December of 2024. So we get a new Senate in 3 weeks and a new president in 5. So, but the thing about that is like 2017, the same party's in power. So will they keep the 21% rate? The answer is highly likely, but who knows? Because there is no accurately predicting what your federal government's going to do. Another consideration that you want to keep in mind is that there are 44 states that also have a corporate tax. And every single one of them does something different. Some of them have a straight franchise tax, but they also tax a percentage of the income, such as a taxation of a regular human being. So every single state's different. Some of them are much more expensive than others. I'm thinking California and New York are as prime examples. And there are major considerations when approaching this as a tax saving strategy. So the takeaway, you can save a considerable amount of money if you do proper planning and restructuring, I should say. This is where somebody like myself, and I refer to myself as a business advisor or CAS accountant for client advisory services accountant. And what we do is we basically take your financials, your books, and your taxes, and we inject it full of steroids and essentially give you the information that you need to make decisions before the fact and actually micro forecast specific scenarios, hiring decisions, for example, tax considerations like we're talking about here, that sort of thing. So that's where I can be of help. And if you feel like I can be a help to you, I'd love to hear from you. So remember, again, we're on 3 different media here. You can message on any one of those and we'll see it. You can also just write directly to Eric, ERIC, at owingsllc.com, and that's spelled just like in the logo there. Um, so with that, um, if there's any questions at all, or if you feel like I might be able to be of any assistance to you, please reach out. Very interested again in hearing from you and helping as many of you as possible navigate the uncertain waters of federal taxation, keeping as much of your money in your pocket as possible. That is our solemn mission. So with that, uh, let me wish you a wonderful Wednesday and the rest of the week. Hope you're all enjoying your holiday season so far. And if you have a chance today, do something randomly kind for a stranger. So with that, have an amazing day.